You're refreshing CoinMarketCap at 9 a.m., and Bitcoin just dropped $4,000 while you slept. Ever wonder why crypto markets feel like a roller coaster that someone forgot to attach safety brakes to? Today, I'll explain why Bitcoin crashes like you're 5 years old. By the end, you'll understand exactly what forces trigger these sudden drops and why the crypto market overreacts to literally everything. Most people think Bitcoin crashes because of secret whale manipulation or Elon Musk tweeting something weird, but the real reason is simpler and way more important to understand. Bitcoin is what Wall Street calls a risk-on asset. When investors feel confident about the economy, they buy Bitcoin. When they get nervous, they dump Bitcoin first. Not stocks, not bonds, Bitcoin. It's always the first thing to fall. Because crypto is the highest volatility playground in the financial world. A 2% drop in the S&P 500 feels calm. A 2% drop in Bitcoin happens before lunch on a Tuesday. The Nasdaq might lose $50 billion in market cap and make headlines. Bitcoin can lose that in an hour. Here's what actually triggered today's crash. Somewhere in the world, economic data came out that scared investors. Maybe job numbers disappointed. Maybe inflation ticked higher than expected. Maybe a Federal Reserve official hinted that interest rates might stay high longer. These things sound boring, but they're rocket fuel for volatility. When interest rates stay high, investors pull money out of risky assets. They park it in safe stuff like treasury bonds that suddenly pay 5% with zero risk. Why gamble on Bitcoin when you can earn 5% doing absolutely nothing? That shift in thinking triggers selling. And in crypto, selling becomes an avalanche fast. A single percentage point change in bond yields can drain billions from crypto in days. Now here's where it gets wild. Most Bitcoin isn't held by individual people anymore. It's held by institutions, hedge funds, trading algorithms, and leveraged traders. These aren't patient long-term believers. They're momentum players. They buy when price goes up and sell when price goes down. And they use borrowed money to amplify their bets. When Bitcoin starts dropping, these leveraged positions get liquidated automatically. The exchange forces them to sell to cover their loans. That selling pushes the price lower. Lower prices trigger more liquidations. More liquidations create more selling. It's a chain reaction that turns a normal pullback into what looks like a market-ending crash. On May 19, 2021, over $10 billion in leveraged positions got liquidated in a single day. This matters to you because these crashes rarely reflect Bitcoin's actual technology or adoption. The blockchain didn't break. No one hacked the network. Companies didn't stop accepting crypto. What broke was confidence. And confidence in markets is emotional, not logical. One negative headline can wipe out weeks of gains because crypto traders react faster than almost any other market. Fear spreads through Twitter and Reddit and Telegram channels in minutes. Panic becomes contagious. And suddenly, everyone's selling at the same time, trying to get out before it drops further. But here's what you need to understand. Bitcoin has crashed like this dozens of times before. In 2017, it dropped from 20,000 to 3,000. That's an 85% collapse that lasted a full year. In 2021, it fell from 69,000 to 15,000. Every single time, people said Bitcoin was dead. Every single time, headlines screamed that crypto was over. And every single time, it eventually recovered. Not because of magic, but because the underlying demand for decentralized money didn't disappear. The technology kept improving. The adoption kept growing. The crashes were just emotional overreactions to short-term fear. So why does crypto overreact so violently compared to stocks? 3 reasons. First, crypto markets never close. Stocks stop trading at 4 p.m. Eastern. Bitcoin trades 24 hours a day, 7 days a week. That means fear can spiral at 3 a.m. on Sunday with no circuit breakers to pause the panic. Traditional markets have built-in cooling-off periods. Crypto has none. Second, crypto has way less liquidity than traditional markets. If everyone tries selling Apple stock, there's an ocean of buyers waiting. Apple trades 100 million shares daily. If everyone tries selling Bitcoin, the pool of buyers dries up fast. Price collapses harder because there aren't enough orders to absorb the selling pressure. Third, crypto attracts younger, less experienced traders who haven't lived through multiple market cycles. They see their portfolio drop 20% in a day and assume it's the end. They sell at the bottom. Then they watch it recover without them. Now check this out. While Bitcoin is crashing, the whales are often buying. Whales are the huge holders who control millions or billions in crypto. They've seen this movie before. They know that crashes create opportunities. When retail investors panic sell, whales scoop up Bitcoin at a discount. They're not emotional. They're strategic. They understand that short-term volatility is the price you pay for long-term gains in a market that some of the biggest Bitcoin fortunes were built by people who bought during crashes while everyone else ran. Michael Saylor's company bought billions in Bitcoin during the 2020 crash. That position is now worth multiples of what they paid. Here's why this matters to your money. If you own Bitcoin or any crypto, days like today test whether you're investing or gambling. Investors have a plan. They understand volatility. They don't check the price every hour. Gamblers panic at every dip and either sell at a loss or double down at the worst time. The difference isn't intelligence, it's emotional discipline. Your ability to ignore short-term noise determines whether you survive crypto's wild swings. Crypto will always be volatile. That's the trade-off for being in a market that can also deliver life-changing gains. If you can't handle seeing your portfolio cut in half temporarily, you probably shouldn't be in crypto at all. But there's a bigger question hiding here. Is this crash a normal correction or the start of something worse? Here's how to tell. Normal corrections happen after big rallies. If Bitcoin ran up 30% in 2 weeks, a 10% pullback is healthy. It shakes out the gamblers and resets the market. But if Bitcoin is crashing alongside a broader economic meltdown, that's different. Rising unemployment or a banking crisis signals a macro problem. Those take longer to recover from. The key signal is what's happening outside crypto. If the stock market is stable and the economy looks fine, Bitcoin's crash is probably temporary noise. If everything's falling, buckle up for a longer recovery period. There's also the regulatory wildcard. Governments around the world are still figuring out how to handle crypto. Every few months, some country threatens a ban or some agency announces new rules. Those headlines spook investors, even when nothing actually changes. The fear of regulation often does more damage than the regulation itself. This matters because crypto is still fighting for legitimacy. One bad regulatory decision in the US or Europe could trigger a sell-off that lasts months. When China banned Bitcoin mining in 2021, the price dropped 40% in weeks. But one positive decision, like a Bitcoin ETF approval, could ignite the next bull run. Regulatory uncertainty keeps institutional money on the sidelines, which limits how much capital can flow in during recoveries. Here's the part most people miss. Bitcoin was designed to be volatile early on. It's a $20 trillion idea trapped in a $1 trillion market. As more institutions adopt it, the volatility will slowly decrease. As more countries build infrastructure around it, price swings will calm down. As more time passes without it dying, confidence grows. 20 years from now, Bitcoin might feel as boring as gold. But right now, we're still in the wild early phase where 10% swings happen because someone sneezed. That's the reality of being early to a new asset class. Gold took centuries to become stable. Bitcoin's had 15 years. So to recap, Bitcoin is crashing today because it's a high-risk asset that falls first when investors get nervous. Economic data, interest rate fears, or geopolitical tension trigger algorithmic selling and leveraged liquidations. These spiral into panic faster than traditional markets. Crypto overreacts because markets never close. Liquidity is thin, and traders are emotional. Whales use crashes to buy cheap, while retail investors sell at the bottom. Normal corrections after rallies are healthy, but crashes during broader economic trouble take longer to heal. Regulatory headlines add fuel to the fear even when nothing real changes. And Bitcoin's volatility will eventually calm as adoption grows. Right now, we're still in the chaotic early phase where fortunes are made and lost in days. But here's the real question. When the next crash hits and your portfolio is bleeding red, will you panic sell like everyone else? Or will you finally understand that volatility is the admission price for potentially generational wealth?